My name's Laura Foll and I'm the co-fund manager of Lowland Investment Company, Lord Venture and Henderson Opportunities Trust. Lowland is a UK income trust that invests across small, medium and large UK companies. It aims to provide income and capital growth for our shareholders. The trust was founded in the early 1960s and it hasn't cut the dividend on an annual basis since then, and at the moment it pays around a 5% dividend yield for our shareholders. Compared to its peer group, which is the AIC UK income sector, Lowland is much more broad in its focus. And what I mean by that is it invests in small and medium-sized UK companies as well. And it's that area of the UK market that's really been out of favour since Brexit. They tend to be more domestically focused businesses, but they remain very cash generative, well-managed businesses. It's just that they're a very unloved area of the market and have been for some time. What that means from the perspective of our shareholders is that the valuation of the portfolio is lower, so they can get an all else being equal higher dividend yield. So effectively you're being paid to wait, you could think of it like that, for those companies to become more loved and hopefully re-rated again at some stage. So you get the benefit of a higher yield for the time being, and hopefully at some point you get the capital growth as we think the intrinsic value of those companies is recognised. The UK has been an attractive market for income-seeking investors for a long time. The UK, at a headline level, so the FTSE All-Share benchmark, pays an almost 4% dividend yield. And that looks very attractive compared to some overseas markets. If you look at the US market, for example, you would get a dividend yield of less than 2% in the US market. So at a headline level, you're already getting over double the level of dividend yield in the UK market. Now that's just the dividend that's paid to shareholders. There are additional cash returns in the form of share buybacks. Increasingly, UK companies are seeing their shares as undervalued. The boards and the management teams of UK companies are often quite frustrated with their valuation levels, so are choosing to return further cash via share buybacks. So even that 4% headline dividend yield that you see in the UK is not the total shareholder return every year. That's actually comfortably above that 4% figure. And actually the UK market, even though it's come under some criticism in the past for having less in some higher growth sectors like the technology sector, we do have a lot of cash generative companies here in the UK. If you think about things like the oil and gas sector, banks, utilities, healthcare, these are all big parts of the UK index. These are very cash generative businesses that are well placed to return that cash to shareholders via dividends. The key differentiator of Lowland versus other UK equity income trusts is that it is multi-cap. In other words, it invests in small and medium-sized companies as well as larger ones. And I think it's important to understand why. So we're not just multi-cap for the purposes of being multi-cap. We're multi-cap because those small and medium-sized companies have the capacity to grow earnings and therefore dividends at a higher pace over time. And the reason for that is that these are smaller companies. They're at an earlier stage of their life cycle, so they have a longer runway of growth ahead of them compared to larger, more mature businesses. So the natural question you might think from that is, why do we own the larger companies as well? Larger companies are, on average, more defensive. If you think about the sector composition of larger companies, there's often more pharmaceutical companies, more utility companies and the like. So the blend of the portfolio with Lowland is that you get the small and medium-sized companies with the aim that they grow faster, and the larger companies with the aim that they provide a defensiveness to the portfolio and a higher level of dividend yield. Idea generation for Lowland is often based on meeting companies. A good management team is incredibly important in smaller businesses in particular. Because if you think about a smaller business, they don't have the management depth that a larger company would have. So whereas a larger business, say a FTSE 100 company, would have a very big executive team and therefore one person maybe can't influence the company to quite the same degree. If you think about a smaller business, the CEO, the CFO and that senior executive team are really the people driving that business forward and can make the difference to that company in a way that they maybe couldn't or would struggle in a large company. So we spend a lot of our time, me and my other fund manager, James Henderson, out meeting companies at conferences, out going on site visits. We really try and get to know the companies incredibly well. That's what we spend most of our time doing. And I think that is the absolute key to the investment process within Lowland.